JAIIB English Medium channel. As you know that we are covering the various topics for JAIIB examination via this increment series. Today in the series we'll be talking about Indian economy and Indian financial system. So module A we have covered. We are left with only 3 units of module B, and today we'll be starting off with unit number 17th, then 18th and 19th. Your module B will be done. So the chapter's name is Monetary Policy and Fiscal Policy. Whenever we say that there are two major economic policies of a country which determine the growth of a nation, then these two policies will be there. We will be talking about these two policies for sure. First one being the monetary policy. As you know that here money is involved, right? Direct money is involved, direct money's reference is there. Fiscal, the textbook meaning of fiscal is certainly related to certain taxes, or for that matter, certain stipulations by the government. So the prerogative of government of India is your fiscal policy. And when we say the monetary policy, it is being ensured, it is being delivered, it is being implemented by the RBI, Reserve Bank of India. So very broader kind of difference between these two economic policies clubbed together, you will find that most of the countries they define these two as economic policy. So monetary policy and fiscal policy, what are the points of difference? So we have the first pointer as monetary policy will be implemented by the central bank of the country, which is RBI in our nation. Fiscal policy implemented by the finance ministry and under the government of India for our country. What is the basic purpose of monetary policy? It is to curb inflation and to have a check, right? Have the inflation under check. For fiscal policy, you will find economic growth is the ultimate aim. And whenever we say economic growth, it includes the economic development as well. Financial management will be the mode of operation via which RBI, or for that matter, any central bank of a country, will be implementing the monetary policy. So, you will be talking about the lending interest rates, the reserve ratios, etc. Fiscal policy, more or less, it is being implemented or drafted, framed by the government of India, the central government of a nation, and more or less implemented via the government's revenue expenditure. The calculation of the revenue of a government, which is what? Simply the earning of a government, and the expenditure, what all is being spent by a particular nation. So more or less we will be looking into unit number 19th, where you will find that this revenue expenditure study is ultimately done using the union budget. Okay, so that is how we define this implementational point of the fiscal policy as union budget. And that is also one of the reason why we in our paid classes cover the unit number 19th just after the unit number 17th, right? Because we have already discussed the fiscal policy. Now it is much more easier for the students to understand the unit 19th, which is simply the union budget. Now, as you must have understood that this chapter will be divided into two parts. One is monetary policy, another is fiscal policy. More or less, the most important aspect of the entire unit 17th will be monetary policy. Fiscal policy, as I have just told you, it will be dealt with in a greater detail via the union budget chapter, unit number 19th. So let's start our discussion around the monetary policy. All of you being a banker must be knowing that monetary policy is more or less discussed, framed, drafted via a committee known as Monetary Policy Committee. So this MPC, whether it was there since independence, answer is no. MPC has been recently established. It was set up after the MOU between the government and the RBI about the conduct of new inflation targeting monetary policy framework. So, in the recent times, we have seen that the central bank is very much active when it comes to performing its duties regarding the monetary policy, and it is the reason why they are very much serious because of this MOU, Memorandum of Understanding. Now, RBI is liable if anything happens to the inflation rate. It is having direct liability to the country, and this liability is defined where? In the RBI Act. So the Reserve Bank of India Act 1934 has been amended by the Finance Act 2016 to provide for a statutory institutionalized framework for an MPC. So whenever we say that a statutory framework has been implemented, it simply means that there are certain legal terms and conditions involved in the implementation or the failure to implement your monetary policy. And along with that, the legal aspects, we must also know certain sections also which are important in the RBI Act 1934. As such, in module C, we will be covering various important sections of your RBI Act 1934. But for monetary policy, there are two sections which are very much important. One is your section 45 ZB of the amended RBI Act 1934. The central government is empowered to constitute a six-member MPC. So you will find that the central government will form a MPC having six members, and the constitution of these members, or for that matter, this MPC is very important. Three will be from the RBI, and three will be the external members, or for that matter, the government of India's representatives. So section ZB talks about the formation of six-member MPC, whereas ZN talks about the failure to maintain inflation target. Fine. So these two sections you must remember: ZN for the inflation target, the failure if it is there. ZB is for the six-member MPC. And this inflation target is what we have seen in the previous lecture also. It is 4 plus minus 2%. The inflation band is this. So it comes out to be between 2 to 6%. But right now, when we say that inflation is less than 2%, so there should be certain repercussion, fine. But since it is under control, there are no repercussion as such under your new inflation targeting monetary policy framework. So what is the function of this monetary policy committee? Simple: to form the monetary policy, but some technical terms are also there, like it is entrusted with task of fixing the benchmark policy rate known as the repo rate required to contain the inflation within a specified target level. What is the target level? Between 2 to 6%. So the primary aim or the primary function of your MPC will be to have the fixation of your benchmark policy rate, also known as repo rate, the repurchase rate as we call it. The MPC replaced the previous arrangement of TAC, that is Technical Advisory Committee. Earlier, prior to MPC, what was the mechanism which was utilized to control the monetary policy of our nation? It was TAC. Okay. Now comes the important question, that what is the composition of this MPC, Monetary Policy Committee, you have to form, but what all members will be included? There are in total six members, already dealt with this. The first and the foremost would be the governor, the RBI governor, who will be the chairperson also. The RBI's deputy governor will be there, who will be in charge of the monetary policy. Then we have one official nominated by the RBI board. So first three, these are directly from the RBI. So internal members we can call them. Then there are three external members who are not from the RBI. The remaining three members would represent Government of India. Fine. The external members, what is the tenure of their office? It would be only 4 years. After every 4 year, you will be having new members in this particular MPC from the side of Government of India. So in the examination, the examiner can ask you that what is the composition, or for that matter, what is the primary aim of MPC. So such simple things also you should not ignore. Now comes the question that how this policy repo rate is decided, or a more pertinent one, that what is the current policy repo rate. So in our examination of JIIB, you will find that the examiner is much more curious about the trends till December 2025. Fine, since the exam is in May, so the updates till December 2025 will be asked. And here at Adda 247, we take the latest updates very, very seriously. So here is the updated data for all of you. So policy repo rate, you have to remember, is 5.25%. And you can see that it is mentioned that till 31st of December 2025, what was the number? 5.25. Earlier it was 5.5, but later on in your June month, it was reduced, or for that matter, in the month of December also, it has been reduced to 5.25. Earlier it was reduced in June, and then in your December also, the 5th December, MPC meeting was there and they reduced it to 5.25. Then in line to this repo rate, you will find two parameters: standing deposit facility and marginal standing facility. Three of them clubbed together, they give us liquidity adjustment framework known as LAF. Now, what is this LAF? See, whenever we say that LAF is at work, we simply want to convey that there is one benchmark rate, which is your repo rate. Right now, it is 5.25. Now, just add 0.25. Adding 0.25, or for that matter 25 basis points, you will get the upper band of this liquidity adjustment, and that will be your MSF, marginal standing facility, right? So 5.25 plus 2.5 will give us 5.50, which is what? Which is your marginal standing facility. And subtracting this by 0.25% will lead us to the SDF, standing deposit facility, which right now stands at 5.00%. Fine here. Okay. So likewise, you can remember all the three important numbers, the data points. What is MSF? It is the rate at which the banks can have certain funds from the RBI in a quick succession. So overnight funding, if the banks want, they can have, but by paying the MSF to the RBI. SDF is more or less now a floor rate, right? That this will be the minimum rate of interest which will be charged. Then we have bank rate, which is more or less similar to your MSF, only 5.50. Earlier, we used to have a variable reverse repo rate, fine, which used to vary with respect to the policy repo rate. So whenever we say that the repo rate is 5.25, what we mean to say is that if the uh, particular banks want to have long term funding from the RBI, they can have the funding by paying the repo rate 5.25 to the RBI. And whenever there is funds which are floating in the market, they are huge, and RBI feels that inflation might occur due to the huge influx of funds. They tend to provide for the lucrative interest rate for the bankers, for the banks, so as to minimize their risk also, because ultimately when they lend more funds in the market, the risk of getting an NPA or shooting up the NPA is more. So against the repo rate, or the flip side of the repo rate, we have a particular rate of interest which will be provided by the RBI to these banks if they park their funds with the RBI. And this is known as your reverse repo rate. Now earlier, it used to be in line, or for that matter directly linked to your policy repo rate. So like here it is 5.25, just subtract 1%, you will get the reverse repo rate as 4.25. But here when we talk about the latest number, it is 3.35. Why this mismatch is there? Because post COVID era, RBI has not changed this fixed reverse repo rate. Right now also it stands at 3.35. Only once after the COVID they changed it to 3.35, and since then it has been maintained to this particular number. So always remember, the latest data is very very important for our examination. SDF, you have to remember 5%, MSF 5.5%, bank rate again 5.5%, fixed reverse repo rate is 3.35%. You can see since the number, you can say 2025 or prior to that also, the number stays at 3.35 only. Then comes the reserve ratios, the RRs. We have two types of reserve ratios in our country: the cash reserve ratio and statutory liquidity ratio. So what is this CRR or the SLR? Simply stated, in order to provide a buffer to our banking system, the RBI has stipulated that the banks must maintain certain amount of their funds which they have accumulated over a period of time in the form of CRR, cash reserve, and the cash reserve will be in the form of what? Cash and cash equivalents. Secondly, the reserves must be maintained under the head of statutory liquidity ratio, which includes not only the cash equivalents but also the liquid assets. Right? So gold can also be there. So CRR, which data you should remember, it is 3% for our examination and 18% is the SLR. And why I'm saying for our examination, because again, updates till 31st December 2025 will be asked, and as on 31st December 2025, the CRR was 3% and SLR was 18%. It has been like this only for quite a few years, right? Now comes the question that how we define the repo and reverse repo rate. What is the interlinkage between these two types of rates? Simply stated, they are the rate of interest which the RBI will either charge from the banks or they will provide to the RBI will provide to the banks if they park their funds. So whenever the funds are being parked with the RBI, we talk about the reverse repo rate, and when the funds are uh, utilized from the RBI, it is the repo rate. So definition is very clear. Repo rate is what central bank lends money to the commercial banks against government securities for a short term. Right? Whenever we say the short term, it will be your repo rate. Otherwise, we will be talking about the SDF, reverse repo rate. Central bank borrows the money from commercial banks and financial institutions for a shorter term. So very rarely RBI borrows the money. Find the better definition, or for that matter, apt definition would be whenever the central bank wants the banks to park their funds there, that particular rate will be reverse repo rate for short term only. What is the purpose of repo rate? To control the money supply inflation, and reverse repo rate will be to absorb the excess liquidity, because ultimately the excess liquidity will do what? It will do harm to the economy and can create havoc in the form of high inflation. What will be the impact on economy when we increase or decrease the repo rate? You must have seen, noticed in every monetary policy committee, the RBI governor will announce that yes, we have decided to lower down or increase the repo rate. So what are the repercussions? See, whenever the repo rate is increased, you will have to, the banks have to shell out more money, right? More money to have from the central bank, right? So in order to arrange funds from the RBI, the commercial banks have to shell out more money whenever the repo rate is increased. And these commercial banks, they are for what? They are for profit maximization only. So not only will they have to provide more rate of interest to the RBI, ultimately the trickle down effect will be for the customers, for the consumers also, and the commercial banks will charge more rate of interest from their consumers as well. So raising the repo rate will discourage borrowing. Why? Because the rate of interest is now high, leading to reduced spending and investment. The investment will ultimately be lowered. Whereas whenever there is a lower repo rate, that means the commercial banks have to shell out lesser money to have the funds from the RBI. So this lesser uh, obligation in the form of rate of interest will be forwarded to the to the customers also, who will be charged lesser for the same you can say amount of money. So lowering the repo rate will encourage the borrowing, leading to increased spending and investment. Similarly, when we study the reverse repo rate, here you will find that more is the reverse repo rate. Right? Whenever the RBI is providing more rate of interest to the banks, they will be much more interested to park their funds with the RBI. And it will do what? It will reduce the liquidity of funds in the market. So higher the reverse repo rate incentivizes banks to park the funds with central bank, reducing the money available for lending as well as spending. And when we say that there is a lower reverse repo rate prevailing in our economy, then banks will not find any reason to park their funds in the RBI, and they will encourage themselves to lend it more to the customers, making it what? More liquid. So lower the reverse repo rate may encourage banks to lend more, boosting the economic activity. Fine. So this was it for today's class. If you want to have a broader discussion regarding all these monetary policy tools which RBI has, then we have dedicated courses for all of you for the May 2026 JAB examination. The classes are already ongoing, so you can uh, participate in those classes while enrolling in our courses. And how you can enroll? Using the mobile number, directly contact us on the 0981 981 9247. And for best guidance for the updated study material, you can directly scan this scanner and join our YouTube channel as well. Fine. So see you guys in the next video. Till then, goodbye everybody. Take care.